It can lift this market that's down 385 points. Paul Dietrich is here from Fairfax Global Markets. Paul, let's just begin with some top-level thoughts. This has been a horrible start to the year, one of the worst stretches for the market in some time. Do you buy it? Do you buy the dip?
I'm buying, and I'll tell you why. You know, you look at what's causing this, which is China, all the other crazy political stuff. And I think the China story is overdone. We're so unsophisticated when we look at China. We can't make the distinction between all the government-owned enterprises and the banks that are slowing down and the consumer that's continuing to buy. We saw from General Motors today that they're projecting bigger car sales next year. Yum Brands with Kentucky Fried Chicken and Pizza Hut, 1.4% just in December up. And I think you're going to be very, very surprised at Apple's sales. I mean, everyone's looking at it as
Apple, actually, you say, is your large cap undervalued stock, your number one pick.
It is. It's a stock that has a 9.5 PE, 46% return on equity, 40% profit margins. And what's going to come out is that people are thinking they're going to have negative growth in China, which only makes up 25% of their sales anyway. They're going to have, they may have slowing growth, but it's going to be growth. And now it's selling at a 30% discount to what it was in October. People are crazy if they're not buying this company.
And just to continue to establish your credentials as a contrarian right now, you have an energy play that you like, too.
Yeah. Elan USA Partners is one of the great stocks. It got hammered a year or so ago because people thought it was in the energy industry. It's a refiner.
But look at the refiners today. Yeah. Valero, Tesoro, they are down more than 10%.
I know, but it's crazy because they make money when the price of crude goes down. One, they have refineries. We haven't built a new refinery in this country for 30 years because of the EPA. They literally have a monopoly, and gasoline prices have gone down slower. Their margins today are going to get bigger. Plus, this company has a 3.9% dividend yield, huge return on equity. I mean, if you're not buying this stock, you're nuts.
So you're not buying the notion that we could be heading toward a recession, in part because the Fed raised rates and is anticipating doing that even more, and our biggest trading partners themselves could be heading toward recession.
In the history of the United States, we have never had a recession when employment was going up, earnings were expanding. You look at the FactSet earnings, we're supposed to have 7.4% for 2016. That's higher than the average of 7%.
I mean, it's a forecast. And as we know, employment peaks before it begins to fall.
It does. But while it's going on, we just haven't had a recession. Now, you got to pay attention to it when you start seeing those things go down. That isn't happening.
When's the last time you were really bearish?
In 2008. And we got out of the market.
Well, that's pretty well timed.
Yeah, we got out of the market where the market went down 57% peak to trough. We were down 8%. That's better.
We were just talking to Adam Parker. Transportation stocks down sharply. Commodities falling precipitously. That doesn't act like an economy that's doing that well right now.
You can't look at energy. That's down 63%. And you look at commodities. But most people benefit from low commodity prices, just as we do with low energy prices.
All right. Let's bring in Bob Pisani here as we head toward the close. Are you going to head out now?
I'll sneak away.
You have another hour of television to do?
Yeah, we'll try to figure out what exactly is going on here.
I walk in and you walk out. Right? I get the message. We're very clear. Fit three. We'll see you a little later.
Bye, Kelly.
Let me just set this up here by looking at a few charts of what has happened so far this year. If you compare the three major averages, the Dow, the S&P, and the NASDAQ, the small caps have suffered the most so far in 2016. We're down, 8% in many cases year to date. The NASDAQ down 10%, so we're in correction territory as far as that goes. I mean, that's just that slide south here. Let's do the same thing for oil prices, WTI and Brent North Sea, which we mentioned today, fell below $30 a barrel for the first time since 2004. There's the slide in oil prices. And while we're at it, the continued decline in yields, and in this one for the benchmark 10-year yield, year to date, now down to 2.06% today, Bob Pisani.
Yeah, there's a broader issue. I understand your exasperation at this. Analysts who look at things on a fundamental basis are exasperated right now because they don't quite understand it. But the oil decline is a symptom of a much larger issue. We are seeing a slowdown in global business activity. That is the broad issue that we're dealing with right now. So look today at just 23 companies that reported in the S&P 500 so far for the fourth quarter. Big names, Nike, Bed Bath & Beyond, General Mills, big consumer names. 19 of the 23 have missed on revenue expectations that have already been lowered. That's a real sign. And these aren't oil companies. These are big global consumer names. Their numbers are coming down because the global consumer is slowing a bit. The global economy is slowing a bit. They're also being very hurt by the strong dollar. And we've seen Nike had some very big comments when they reported. They reported a little while ago, but they had some comments about how much the strong dollar is hurting them. And I think that's the real overarching concern.
You know, Art Cashin made the point earlier today that it's not the Chinese economy that has the markets worried right now. It's the Chinese currency and what government regulators are doing to the currency over there right now as they try to
today,
continue
just apropos of that, when China was down, but you saw the currencies here stable, and Europe and our markets opened up as a result of the stable currency. So you're right. It's exactly what...
A lot of people think that currency, the Chinese currency, ought to go down by 10% to be kind of fair value. The U.S. government has been trying to drive down Chinese currency for years. They are now doing it.
Not all at once.
Not all at once, but they are doing it. Now, this is a massive benefit. I'm sorry, Mr. Trump, but this is a massive billions of dollar benefit to the U.S. consumer that the Chinese government is giving to us, because 5 months from now, everything you buy at Costco and Walmart is going to be cheaper. This is going to be great for profit margins for, the retailers.
So again, you're like Adam Parker. He's looking at the economy from the consumption side of the ledger, not the production side, and the consumer benefits from these.
We had this in 1986. You were too young to remember, and you were too. But in 1986, remember, Saudi Arabia dramatically increased the production, and all of a sudden, the oil price went from $30 to $10, and the consumer did benefit. In fact, consumer spending did move up a little bit later on. But I think there's a little bit of a broader thing going on here than just the oil price here. We're seeing global commodity deflation on a level we haven't seen even back then at that point. I think this might be a little bit...
Yeah, but don't you think that that's partially because of China no longer doing these massive infrastructure projects? They were driving the commodity prices, and they were overvalued if you take China out.
Paul Dietrich, good to see you. Thanks for joining us
very
much. Bob, we'll check back with you.